let's now discuss doing some one DTE trades that you can execute to try to make $100 a day, or at least $70 to $100 a day, and how you can adjust it using the roll out. You can always adjust it using the roll away and the roll ups and so forth. But today I'm just going to talk about when using the roll out type of strategy. Okay? So if we were, as you guys know, this morning we had to adjust the trade and roll it out. But let's just say that we were still in the trade at this point, and we had something on like like even like this right now. And let's just say 20 points wide. This was the trade, and then let's just say this put side was really far away because we're not being threatened on both sides. All right, so it'll cost us $300. Basically, what we wrote out for today. So it costs us $300 to buy this back if we had to do the opposite. Okay, so right now it says a credit. If we switch this to a net debit, it's going to be the same thing, right? So it's going to cost us 300. So we got out of the trade, and now we decide, okay, well, we're going to roll this out to the next expiration period, or we can do it 7 days, we can do it 30 days. But in this case, we would roll it to we would take the 0 day and move to one DTE. But we do not have a one DTE or three DTE at this point because we just discovered that we have the President's Day holiday on Monday. So what we would do is try to roll out and reposition the trade to give ourselves some better odds. So for example purposes, we rolled this out earlier today and we sold that, and right now it's a 7 delta. And on this put side, if we rolled this, then it would be a 4 delta. So if we added on the contract, we still wouldn't have enough here to get what we wanted, right? We're only getting 150, we need 300, so we're going to try to get something like 340. So what we would have to do, let's say the call side was the problem. So what we would do is move this call side up. And let's say we put this call side at this 4120, and it's the 4140. Okay, and then I'm talking about a rolling out into an iron condor. We originally had an iron condor. We had to buy it back because one side is being tested, and even right now, if we were almost darn near at the money, we can roll that out at this point for it costs about $300. We're saying we're going to need about 340. So it was a 10-point wide spread. So what I'm doing here is I just moved the call side up to a 17 delta. That's giving me right now 310, as you guys can see. And then if I move this put side up, and I say the put side was the problem for most of the day. Let's say we put this at a 9 delta. I'm just putting it here because of I don't want to put something on at 39.80. All right, so actually it's only a 10-point wide spread, so we can do something like this. Right? So now you see that we're collecting 390. What we did was we had one contract, and then we rolled out in this example, turned it into 2 contracts so that we can reposition the trade completely to have a high probability of winning, and that we have a lot of wiggle room on the put side for the market to go down, and a lot of wiggle room on the call side for the market to go up. Tastyworks is saying we would have a 75% chance now to win at expiration by rolling this out. Based on what we were just talking about with Judy, we kept the width of the spread the same, but we did increase the max potential loss because we added a contract. Okay? And adding a contract is going to increase your max loss, but we did increase our probability of success. So it's trade-offs with this type of rollout that I'm talking about. You can always do a rollout and not increase your contracts, but in this case, you would have to be closer to at the money to be able to get the premium that you want. But if you want to increase your probability, then adding another contract or increasing the width of the spread can work for you. When I say increase the width of the spread, let me show you what I mean. So if I take one contract away, so we had 2, we now have 1 contract on both sides. We're only receiving $200 now. We said we wanted 340. So if I decided that I was going to make this instead of 10 points wide, I was going to make it 15 points wide. So that's giving me a little bit more. And then I made this 15 points wide. So that's giving me 280. That didn't work. But if I made this 20 points wide, so that's 20 there, and then I went here and made this 20. So now we're getting 340 that we wanted, right? I kept it one contract, but I increased it from a 10-point wide spread to a 20-point wide spread. That is the same scenario as basically adding another contract. Your max risk is the same. It's actually a little bit more than adding another contract, because as you can see here, the max loss that they're asking us to put up is about 1620. If I, or in the credit you're receiving is about 340, right? If I go back and do the 10-point wide 2 contracts, we're actually going to receive a little bit more. So the credit, the max loss is going to be less. As you can see here, that's the buying part they're requiring you to put up, and then this is the credit, right? We're getting about $60 more, give or take, by doing 2 contracts here. We are increasing the probabilities, but also increasing the max loss with this type of rollout. We did this exact type of rollout when we did it this morning when we had to roll out. We went from 1 contract to 2 contracts, kept it 10 points wide. You can see that that's a 6 delta right now on the call side, and then this is a 4 delta on the put side. So if we want to see how much our probabilities would be if we were putting on this trade right now, you can see that if things work out, I mean, it should, based on these probabilities, we have an 88% chance of winning at expiration on Tuesday when we come in. Right? Doesn't mean we're going to win. Nothing's 100% when you're trading. But this is by adjusting what we did this morning and the market basically staying where it was, we are now at a really good position to be able to win on Tuesday when we come in. Okay? After potentially being in the money this morning, if we would have stayed in the trade, but we adjusted before we were in the money because we were following the rules of the green, yellow, and red zone. Right? We wasn't doing a automatic stop, but we did have a stop, a manual stop, a manual risk level that we would say, okay, this is too much risk. Let's reduce some of that. And in this case, we reduced or we increased the probability of winning. So that's reducing your risk of losing. But obviously, we increase the max possible loss we can have if things just, significantly deteriorate from now until Tuesday when we're able to, trade this again. So you would obviously want to initiate the trade the way we were talking about. If we were going to do this if we were going to put this trade on right now, we would want to collect something like $70 to $100 if we were trying to make at least $100 each day or every time we did this strategy, something such as that, right? So, and I'm talking about before fees and commissions. So if I wanted to get $100 here, I can put this at a 9 delta. That's 10 points wide, and obviously you can go wider, but I'm basing this on doing a 10-point wide right now. Right? So this is a 10-point wide. If we did this, you would have an 80% chance of winning at expiration on Tuesday, and you're collecting $140 here. So if you wanted to collect a little less, get out a lower delta here, that's 130 there. And then if we move this call side to something like this, that's about 105, 110. So, but your probabilities are a little higher, but not significantly higher. But it's, these 5 points can be huge for short-term trades. So you set it up, and if you set it up with a 10-point wide spread, and if you start this with, let's say, $5,000, and you start this with 5K, and you say, I'm going to allocate $5,000 to my 1 DTE trading. I'm either going to grow this significantly or I'm going to lose this 5K. But I'm going to treat this 5K with special risk treatment. I'm going to try to make money off this 5K without losing it, and I'm going to be very vigilant about my trading. But I'm going to use it in a way that allows me to adjust by rolling out when something is wrong. And you can do this even in an account that's less than 25K, because you're only going to be moving your position once a day, right? You're either going to take it off because you win, or you're going to roll it out. And if that's moving it once a day, that's not considered a day trade, because a day trade is when you touch a strike twice in the same day. Okay? You touch it once, that's not a day trade. So in this case, we got 5K. Then what we can do is try to collect that $100, and then when something goes wrong, then we're going to because that first trade is going to use $1,000. Let's just say without the credit we're receiving. The first trade, 10 points wide, is going to use $1,000, right? And the second trade, if you have to adjust and add a contract, so now you're using $2,000, not including the credit. It's actually going to be less than $2,000, but I'm showing you how this can work, right? Out of your $5,000. Then let's say you had to adjust again, and so your first probabilities are 80+%. You had to adjust. Your second probabilities are 80+%. You had to adjust. Now your third adjustment, you're going to have to use, another 3. You're going to be using 3,000 now. Now your probabilities are 80+% again. So the odds on you going to lose 3 times in a row of having 80% probabilities are not very high. I would say it's definitely less than a 5% chance, maybe closer to a 1% chance. But that doesn't mean it's a 100% chance you can't. But this is how you can adjust this to to win and use only 5K of your account that you're trying to collect $100. Some days are going to be great. You're going to get that money. Some days it's going to be a little bit more challenging, like today, and you hopefully you can get it the next day. We'll see how this actual trade plays out on Tuesday. But this is how you can use a 5K account and trade the SPX, one DTE type of trading, and make an adjustment without affecting your day trading pattern rule counter, because you only can trade you can only day trade 3 different times, right? So if you if you do that too much, your account can be frozen up for 90 days. If you're on Tastyworks and on Thinkorswim, they can freeze your account, into perpetuity if they wanted to, until you add 25K, which is crazy, but some broker firms operate like that. This to me is a really high probability trade.